Hey everybody, how are you tonight? We're going to get started in just a minute. All right, well, it's 8 o'clock. I want to welcome everybody to um, my webinar tonight, Year-Round Strategic Tax Planning for Real Estate Investors. Tonight, we're going to, have some fun, talk about tax strategies for real estate investors, and hopefully everybody picks up a little bit of something that, they wanted to know. And you can feel free to put questions into the chat if you'd like. Um, that's always fine, and I'll try to get to all of those questions as we go along. So why don't we? I'm just going to share my screen here. Um, and share my screen first. All right. So can you see the slides? Somebody just let me know if you can see the slides in the chat.
Yeah, Ted, we can see them.
Okay, awesome. Thank you so much. All right, guys. All right, so year-round tax planning. For those of you who have no idea who I am, my name is Ted Lanzaro. I am a real estate CPA and a real estate investor. I have been doing this for 30 plus years as a CPA, and then as about 20 plus years as an investor, primarily doing single family and multifamily rehab and renovation. Done some landlording, done a few small syndications, owned a few small apartment buildings back in the day. Mostly now, I'm mostly a passive investor. I'm about to release a new book called Year-Round Tax Planning for Real Estate Investors. It's coming out. Everybody's going to get a copy um, when it's done. I'm still in the process of editing it, so we'll do that. Everybody's going to get a copy. So what are we going to talk about tonight? Well, we're going to talk about the process of um, we're going to talk about the process of tax planning. We're going to talk about why strategies need to be tailored to each individual's unique situation. We're going to talk about why it pays to be both proactive and granular when you're doing planning. We're going to talk about, if some of you are real estate agents, we're going to talk about why you have to be real estate investors. I'll tell you a good couple of stories. We'll talk about the three kinds of real estate investors and how that affects your taxes. We'll talk about planning strategies for each of you, because I know there's some passive investors on here as well as some active investors. Why qualifying as a real estate professional is an incredible strategy. Everybody knows that cost segregation is a good strategy. When is it not a good strategy? There's some situations where it's not a great strategy. We'll talk a little bit about 1031 exchanges. We'll talk a little bit about safeguarding your taxes. We'll talk about retirement planning a little bit. We'll talk about the difference between an S corp and an LLC, and we'll talk about entity structure, and then we'll take some questions. And along the way, if you put questions in the chat, then we will I'll try to answer them as we go along. So here's the thing that I want everybody to remember. Everybody's different, right? Some of you on this call are W-2 employees. Some of you own businesses. Some of you own real estate businesses. If you own real estate businesses, and we'll talk about qualifying as a real estate professional, I mean, that is literally one of the best strategies there is. Some of you are landlords. Some of you might be, doing flips and rehabs. Some of you might be doing syndication. Some of you married, single, some of you, have very high income, maybe some of you have lower incomes. different goals and limitations. We talk about limitations all the time. I could tax plan you so well that you'll never get a loan, right? Literally, right? So, we have to take into account if you're trying to, if you're in the process of refinancing something or trying to get a loan for your next project, maybe, we have to kind of take it easy on the tax planning because otherwise maybe you don't even qualify. Some people have a couple properties, some people own hundreds of units, thousands of units, right? So the number of properties you own and whether you're active or a passive investor, whether you qualify as a real estate professional, all of those things make a difference. So we're going to cover why all of those things make a difference and how to tailor strategies to those unique situations. So I'm a big believer in being both proactive and granular. So the whole concept I talk about year-round strategic tax planning. The whole concept of strategic tax planning is that we're being proactive during the year, right? And so I always tell my clients, listen, I want to know before you buy a property, before you sell a property, and before you start renovating a property, because there are strategies that I'm going to want to help you implement during that time to help you with the planning. So I need to know about them in advance. And I just got done doing somebody's taxes the other day who didn't tell me that they had sold the property in advance, didn't realize they had a $300,000+ gain on the sale of that property. And I was like, oh, I wish you had told me, there could have been something we could have done about it. And so it wasn't the best scenario. We could have had a much better, much more high level conversation had I known about it last year when it happened, as opposed to, September 16th. Right. So being proactive, talking to me about, anything, even like major decisions like buying an automobile or buying equipment for your business, those are all things we should be talking about in advance. One of the reasons, just as an example, and some of you on the call may have used this strategy before, but so clients call me and they say, look, we're about to renovate a property. I'm like, great. I said, you need to make a list of everything that you take out of the property and throw in the dumpster, literally, not you personally, the contractor, right? So the reason you want to do this is because let's say you buy a property, right? So basically in cost segregation, there's a thing called an abandonment study. And it means if I'm doing a renovation, what did I remove from the property? So if I buy a property, right, I buy all the things that are inside of it also, right? So if I bought a 10-unit apartment building, I essentially bought 10 kitchens, 10 bathrooms, right? A whole bunch of bedrooms, a lot of closets, So as I'm removing things if I'm doing a renovation and I'm removing, let's say I'm gutting all the kitchens and all the bathrooms, all of those things have some value that needs to be assigned to them. And then you can take a loss on those in the first year on those items that were removed from the property, right? Now it does reduce the cost basis of the property, but it's an automatic deduction. And for people who are syndicating or using passive investors in their deals, this actually also skirts the passive loss rules so that your investors also get to take advantage of the losses where they might not be able to take advantage of the rental losses or appreciation losses. So this is a really good strategy. So by being proactive, I can tell you how to go about doing that, right? And that should really make a difference. Granular. What I mean by granular is looking into the details of individual transactions. And this is more, this is with clients, but it's also with management companies. Management companies, when you have a management company that is, doing the accounting for your business, a lot of the management companies for the syndication properties that they do, they put a lot of repairs into CapEx, right? And if you put repairs into CapEx, then what you're essentially saying is, I don't want to expense them in first year. I want to take depreciation. I want to depreciate them over 27 and a half years, right? So instead of $100,000 deduction, I'm going to get a $2,700, or whatever, $2,000 deduction, right? Whatever 100,000 divided by 27 and a half is. So what we do is we literally go through the general ledger and try to identify things that actually either qualify as expenses, right? Repair expense doesn't have to be capitalized. It's not a major renovation, project. It's just some repairs that just happen to get put in the wrong place by the management company. So we're looking for those kind of things. So by being granular and maybe spending an extra half an hour going through the general ledger, I've saved clients, I've turned, $50,000 worth of CapEx into $50,000 repair deduction, right? That on 25%, that's a $12,500 tax savings, right? So being granular helps, right? Being detail oriented helps. And same thing. I mean, sometimes I'll just go through people's, on a smaller example, might be going through somebody's meals and entertainment and noticing that now meals and entertainment, if you and I go out to lunch, I buy you lunch, I can only deduct 50% of that lunch, right? Under 2024 tax law. But if I buy lunch for my office staff on a Saturday because they came into the office, that's 100% deductible, right? Same thing, if you've got a construction crew or a group of real estate agents or whatever, and that you're buying them lunch or dinner just to keep them working on something, that's 100% deductible. So by being granular enough to go through the general ledger and looking for those things can add up, right? If I find a couple $1,000s worth of that stuff, that's $500 in taxes that you saved, right? So being proactive and being granular are very effective strategies. So I have a lot of investor clients who are also real estate agents, and it always surprises me that a lot of them aren't actually investors, right? And so I'm like, geez, that's kind of surprising that you're not investing in real estate. And some of them, I had a guy come to me not long ago, and he makes $400,000 or $500,000 a year as a broker, and he has no real estate. And he's like, Ted, he's like, I know you're really good with, with tax savings and stuff. He's like, what am I missing? I feel like I'm paying a lot of tax. And I said, well, send over your return. Let me review it for you. And so I took a look at his return, and what I noticed was he didn't have any investment properties, right? So I said, listen, you've got to, if you want to, because you qualify as a real estate professional, if you want to take advantage of the biggest tax strategy there is, you've got to own rentals, right? And not only do you have to own rentals, but you should be trying to pick up a new rental every year, right? And why does anybody want to own rentals? Well, they want the cash flow, they want the potential appreciation, right? But they also want the tax benefits, right? And the first year depreciation on a new rental property can wipe out, a substantial amount of income. I had another broker client of mine come to me, and he had just sold a big property, had $1 million commission on it. And he said, Ted, I'm going to make $1 million this year. What can I do? And this particular guy has some apartment buildings. So I said, go and buy another apartment building. He's like, I had my eye on a building. I said, yeah, go get it. Right. So he went, he bought this building, he bought it for $2 million. And he got 25% cost segregation on it. So he was able to cost segregate $500,000 of that out. And this was at a time when there was still 80% bonus depreciation. That was 2023. This year, 2024, it's 60%. But that was last year. So he got a $400,000 tax deduction on $1 million worth of income, right? So now instead of paying tax on $1 million, he paid tax on 600. But it gets even better because I introduced him to a guy I know because he doesn't have any employees, and I introduced him to a guy I know who does what's called the defined benefit plan. It's a kind of a actuarial retirement plan that allows you to high income earners to put away a lot of money into retirement and defer it. So he was able to put another $200,000 into a defined benefit plan as a retirement plan contribution. So he started with $1 million, deducted $400,000 of depreciation, then deducted $200,000 retirement planning. He actually ended up only paying tax on $400,000. Now, the real deal on that is that that's the highest bracket income, right? So So taking $1 million down to 400,000 that's taking money down at 35%, right? So a $600,000 deduction is worth $200,000 in tax planning, right? That's why, because you're a real estate agent and qualify as a real estate professional, you're able to do those kind of things. And the other thing is, you're in the business. You're able to go and see. You get first shot at everything that's coming available, right? You're able to cherry pick deals, and also create deals, right? Another commercial agent that I know had a client was looking for a long-term lease. It was a manufacturing company looking for a long-term lease on a new facility, right? So he knew what all their terms were and everything. So what did he do? He went and bought them a building. He went and bought the building and leased it to them, right? He knew exactly what they wanted. He found what they wanted. He said, look, you don't want to buy it. I'll buy it and lease it to you. So he created his own investment. Those are the kind of things you can do as an agent in the business, right? So real estate agents, keep those ideas in mind. Types of investors, right? There's essentially three types of investors. A passive investor invests in other people's deals. Basically, they provide the money for basically a stated return, a piece of the action, something that they'll get on the back end, but they're in it for the return on investment, right? I'm going to put in 100,000. I'm going to expect to get back 8% a year for 5 years, whatever, right? Whatever the deal is, right? They don't have any management control, right? So they're completely passive in the deal, right? Now, being a passive investor is a nice way to get some tax-free cash flow. We'll talk a little bit about that in a minute, but you don't really get a lot of tax advantages to it, because passive losses you can only offset passive losses against other passive income or capital gains from real estate. You can't reduce your W-2 or business income with losses from passive investments. Okay, you have to be active in order to do that. An active investor is somebody like what I used to do, or what I was just describing from the real estate agents. Somebody who buys their own deals, maybe manages their own deals, does their own flips. That's it may be their business, right? Or it may be something they do on the side, but they do it actively. They're actively engaged in it, right? They're making the decisions. They're calling all the shots on the deal, right? So they're an active investor. An active investor is allowed to deduct up to $25,000 of rental losses a year against their ordinary income, against their W-2 income or their business income, assuming that income does not exceed $150,000 a year. So once you go over $150,000 a year of other income, you lose that ability to deduct rental losses, and those rental losses become a carryover. Just like the passive investor doesn't lose his rental losses or his or her rental losses, they just get carried over to the following year. We'll talk a little bit more about that in a minute. But same thing with an active investor over 150,000. If you're an active investor and you make over $150,000 a year, you're essentially a passive investor, because you can't deduct the rental losses against your ordinary income. Now, the holy grail of investor types, the one that allows you to deduct unlimited amount of losses against your ordinary income, is what's called real estate professional status. And in order to qualify as a real estate professional, you have to have at least 750 hours of real estate activity in your business, and it needs to be more than 50% of all your business activity, right? So if you have a W-2 job and you're working 2,000 hours a year, right? You might have 750 real estate hours, but you really need 2001 real estate hours. So it's got to be more than 50% of what you're doing, right? So you have to kind of have to keep that in mind, whether or not you qualify. Now, here's something that's kind of cool. If you're married, your spouse can qualify. So we have a lot of high income individuals whose spouse is interested in real estate, and we try to, we tell them, we consult with them on basically how to get real estate professional status for their spouse. Maybe their spouse has an interest in real estate, but they're not working currently, on something else, or they have a part-time job or something, and they can put those 750 hours in, managing properties. So we have a methodology. We help people, design portfolios that are a little time intensive, right? Kind of investments that you have to, actively manage, or manage construction or that sort of thing. They take time to do, and we get those spouses involved in that. We get them to qualify as a real estate professional. That's a really good strategy if you can do it. Now, if you're already in the real estate business, you don't have to do that. You already qualify, right? So all the activities, so people always ask me, like, what qualifies? All the activities related to the operations and marketing of a business qualify. And there's certain types of real estate businesses that qualify. And those businesses you can see on the slide are real estate development, real estate redevelopment, like flipping houses or renovating apartment buildings or doing conversions, construction, home building, construction, or building commercial buildings counts, doing like syndication, like acquisition of properties counts, rental operations of property management, just running your own rentals or managing properties for others counts, being a leasing or brokerage agent counts. So all of those business activities can qualify you as a real estate professional. And what that does is it opens up the whole world of strategies to you, right? Now, so let's talk about the real estate professional strategies first, and then we'll go back and talk a little bit about passive and active strategies. So real estate professional strategies allow you to take the maximum deduction on your cross segregation studies, right? So that's an awesome advantage. You can, everybody, passive, well, not passive, active and real estate professionals can both do 1031 exchanges, right? Passive investors can do 1031 exchanges, but typically they're going along with the entity they invested in as part of the exchange. They're not actually doing the exchange themselves. They're kind of just, the operator on their investment, whoever they invested with, is doing the exchange, and they're just electing to go along with it, right? But active and real estate professionals can all do 1031 exchanges. We'll talk a little bit about that. Real estate professionals can maximize their deductions against their ordinary income, right? So let's say you have a lot of ordinary income from your brokerage, say, or from your rental properties or something, and you can say, well, look, I've got a lot of income this year. For whatever reason, maybe I have a lot of income because I did something special that year. Something happened, I sold a property, right? Or something occurred, I got a big commission on something, right? So now timing is everything. Now, so we talk to clients about, when we do tax planning, we talk to clients about timing. Hey, I just made a whole bunch of money, like in the example I gave you before. What can I do, right? And well, do one of your properties need any major repairs? Let's do them before December 31st. Why? Because it's more beneficial to expense repairs in a year where you have high bracket income than it is when you have a year where you have low bracket income. So it's better to take 300,000 down to 250 than it is to take 50 down to 0. Why? Because there's a difference in the bracket, right? One bracket, the higher bracket, you might be in the 25 or 28% bracket, right? Going to 50 to 0, you're in the 10% bracket, right? So you got some tax savings, but that 50 saved you 5, whereas it saved the person that went from 300 to 250, it might have saved them 12 or 13, right? Instead of 5. So there's a big difference. So you always want to try to time and maximize deductions in the years where you have the highest income, right? So another great way to reduce your income is with retirement plans, right? Now, think about this. For passive investors, this is what I tell passive investors all the time. Maybe you can't deduct the rental losses that are coming through on your K1s, but you can use the cash flow you get from them to fund your retirement plan, right? And that becomes a tax deduction, right? So if you're at a W-2 job and you're not maxing out your 401k because you live on most of your money, right? Well, then when you get your distributions from your passive investments, maybe you can't deduct the rental losses, but you can use that to put into your 401k and maximize the deduction you get on that, right? Same thing with active investors, right? Like, so one of the things when I have an active investor that's close to that $150,000 threshold, right? So I had a client had $160,000 of rental income, or not 100 of rental income, $160,000 of taxable income, right? So now they're not allowed to take their rental losses, right? Well, I said, wait a second, did you fund your retirement plan? No, I haven't. All right, well, let's make a SEP contribution of $20,000, right? That SEP contribution is going to reduce your income from 160 to 140, right? And now, so the way the phase out on rental property losses works is you lose 50 cents for every dollar that you so if you have at $10,000 less, 100. If you're at 140, you can deduct $5,000 of rental losses, right? If you were at 100, you could deduct the whole 25, but at 140, you're allowed to deduct 5. So what did you do? By making that $20,000 retirement plan, not only did I reduce my income by 20,000, but I also got $5,000 of rental losses. So that's like a double whammy. I spent money twice. I got 2 tax benefits, right? So instead of getting a $20,000 tax benefit, I actually got a $25,000 tax benefit, right? So you always got to look, as an active investor, you always got to look at what can I do before the end of the year that's going to take my income back below, if I'm close, take it back below 150,000 so I can take advantage of my rental losses, right? And we're going to talk about this a little more in depth in a little bit, but we're also going to talk about S corporations versus LLCs and what makes an S corp a better vehicle for not only real estate professionals but for active investors also to use an S corp when they're running a real estate business like flipping houses or brokerage or home building or development. Okay. Let's talk a little bit about depreciation, why it's so awesome. So depreciation is basically just the rational allocation of the purchase price of a property, right? I bought something for $1 million. I'm typically going to take somewhere between 15 and 20% as the land value. That leaves me with 80 to 85% of building costs that I can depreciate. If it's a commercial building, it's normally depreciated over 39 years. If it's a residential building, like an apartment building or a multifamily home, it's depreciated over 27 and a half years, right? Now I can cost segregate it, right? So if I have the income and I want to take the income down, using a cost segregation study, this is when it's a great idea. When I have high bracket income, right? And I have a new rental property and I can cost segregate it and reduce my income in a high bracket arena. Because like I was telling you before, there's a big difference between taking, like in the example I used before, there was a big difference between taking it from $1 million to 600,000 than if you had taken it from 400,000 to 0, right? That difference could be like about 5% of a $400,000 deduction. That's 20 grand. Right? So you got to always kind of look at that, like how much am I really saving by doing this cost segregation study, right? So a cost segregation study takes the component parts of a building and breaks it down into 3 distinct categories, right? We already talked about the land allocation. So you're going to have the regular building, right? That's typically the building envelope and all the walls and stuff that are in there. The tangible personal property is all the stuff that I can basically unplug, unscrew, somehow detach and walk out with, right? So it's kitchen cabinets, it's in a residential building. It's kitchen cabinets, it's sinks, vanities, tubs, toilets, um, the countertops, appliances, all of these things, decorative lighting, shelving, all of these things that I can do. And on a typical property, you're going to get, like on a good sized apartment building, you're probably going to get about 15% of the cost as tangible personal property. Land improvements are the biggest land improvements, basically the parking lot or the driveway, right? Because they're typically expensive. The land improvements can include fencing, sidewalks, like I said, the parking lot. If you have an apartment building with a pool, that would be considered a land improvement. Piping and stuff like in mobile home parks. All of the electrical and plumbing infrastructure of a mobile home park is considered part of the land improvements. Sewer lines and stuff are considered land improvements. All of those things can be depreciated over 15 years. Now, both tangible personal property and land improvements are also subject to bonus depreciation, right? So we're going to allocate on $1 million building. We're going to say we allocate. I'll show you an example, right? Well, this is on a $500,000 building, right? So on a $500,000 building, we took 20% land, 40% building, right? Well, now we were able to allocate 10% to 5-year assets. We allocated about 2.5% to the 15-year asset. That left $360,000 with the building, right? What's the difference? Well, and this is a really not a great example because the difference is not that big. But you can see right here, there's a basically this is without bonus depreciation, right? Without bonus depreciation, the extra deduction is $7,200, right? Now let's look at it with bonus depreciation, right? So here's in a $2 million purchase. Here's basically some losses that occurred, right? Now we have earned income. The real estate professional on this example can take 120. Now he's got $80,000 worth of taxable income. The active investor was only able to take 25. The passive investor was not allowed to take any. Right? See the difference, right? So it makes a big difference whether you're an active investor or whether you just qualify as a real estate professional. And the idea is you want to cost segregate properties when you have a lot of income to offset, and then it really makes a difference. Now, the other thing that you have to know about cost segregation is that you ultimately will have to recapture this depreciation when you sell the property, right? So when you sell the property, whatever depreciation you've taken, you now have to recapture. Okay, and what that means is you take it back in as income. What's cool about this, though, is that the maximum recapture rate is 25%. It's based on the rate you pay recapture on is based on your ordinary income rate. Okay, so if your ordinary income rate for that year is 15%, well, you're only paying 15% recapture. Right? But the maximum it could be is 25%. So when I talked about taking big dollars down with cost segregation, like from $1 million to 600, and I'm deducting it at 33%, say for example, now when I go to recapture it, I'm only recapturing at 25. I've got an 8% spread. Not only did I get the time value of the money between the time I didn't pay the taxes and the time I sold the property, typically, could be 5 years, could be as long as you want to hold the property for, right? Not only did I get that time value savings of the money, but it's a real win when I can get the arbitrage spread, right? Now, correspondingly, if I use a cost segregation study to take dollars down from like so here, like this is a perfect example. I'm taking dollars down from 200 down to 80. So I've got $120,000. Now, ultimately, I'm going to recapture that $120,000. What if I have to recapture that $120,000? So here, I probably save something like 18%, right? But if I recapture it in a year where I made $400,000, now I'm recapturing it at 25%, right? And if I haven't held that for a long, long time, I actually lost money on that cost segregation study. So you never want to do a cost segregation study in two examples. One, if you have a short time frame for selling that property. So you don't do a cost segregation study if you're selling the property a year or two from the date you do the study, right? The other thing is if you expect, and this is why we do multi-year tax projections for a lot of people, if you expect your income to go up in future years, and you have determined that this particular property is a 5-year hold, but you know that your income is going to be much higher in year 5, well, it might not make sense to do a cost segregation study. Why? Because you're going to recapture at a higher rate than you got the tax savings on, right? And 5 years is a relative. If you're doing that and you're actually losing money on the arbitrage on the spread, then 5 years is not a long enough time for the time value of money to make up for that. Does that make sense? I hope that makes sense for everybody. All right. Let's talk a little bit about 1031 exchanges. 1031 exchanges, I think 1031 exchanges are like literally the most powerful wealth building tool in real estate. Maybe 1031s and carried interest are the two that I love the best. But 1031s are so powerful. I remember and this goes back 20 years ago, right? 20 plus years ago, maybe more like 30. Well, it was my first client that did a whole series of 1031s. And I had this client who was a plumber, and he had accumulated over the course of about 10 years. He had accumulated a whole bunch of small properties. I was living in South Florida at the time, and he accumulated a whole bunch of small properties, right? Single family houses, duplexes, triplexes, and he decided he wanted to get out of those. So we actually sold them as a whole portfolio, right? And he went and he bought kind of a beat up shopping center right on US 1 in South Florida, Main Drag. And he did a 1031 exchange into it, right? So he didn't pay any taxes. So he had about $1 million gain on the sale of his portfolio. But he didn't pay any taxes on it because he deferred it by doing the 1031 exchange into the shopping center. And for a couple of years, I would see him out. Every time I drove by there, he'd be out there working on the shopping center or whatever. And when he got done, he leased it up and he turned around and he sold it. And he sold it for a $2 million gain. So now he's actually got $3 million of accumulated gain, right? $1 million from the first sale and $2 million from the second sale. And what he did was he went and he bought 6 auto zones in Texas, right? And these were triple net lease properties. He didn't have to do any work, right? He just collected net rents, right? So what he did was he had created for himself about a $40,000 a month net rental income, right? And he retired essentially, right? And he'll probably have those auto zones until he either dies or AutoZone goes out of business, right? So he just set himself up, and that's the power of using 1031 exchanges to ladder up properties, right? And that's what you really want to do. You want to be laddering up. It allows you to defer 100% of the capital gain as long as you're buying you're trading one rental property for another, right? And the key is that it must have a greater or equal or greater value. So you sell $1 million property, you have to buy at least $1 million property to be able to do a full exchange. And the way that works is you have to identify the property within 45 days of the closing of the sale of the first property, right? So you sell the property, you have 45 days to identify a new property, right? And then you have 180 days to close on that property, right? Now, what do I tell clients now who want to do 1031 exchanges? Start shopping before you even put the property on the market. From a tax standpoint, right? You have 180 days to close on that property, 45 days to identify it. But from a reality standpoint, you probably want to have a property, that you really want, that you've identified that's a good property, and then you go and put your property on the market, because a good rental property, if you've got a good rental property you want to get rid of, it's probably going to sell pretty quickly, right? So having a property identified, a better laddered up property identified, right, is a really good practical strategy to implement, the tax strategy, right? Because otherwise, once you're on the clock, you don't want to get stuck with having to buy something that really isn't your ideal property, right? You really don't want to do that. You want to buy something that, makes sense for you as an investor also, right? So that's the power of 1031 exchanges. I think everyone should be using them. Here's something that I'm really passionate about. If you haven't noticed, I'm passionate about this whole subject, but this is something that I'm really passionate about, which is safeguarding and maximizing your tax deductions, right? So in order to do that, you have to have a good accounting system, right? You've got to keep your receipts and your paperwork, right? I always tell when I do talks and stuff, I always tell the story about, driving around with this contractor and his whole dashboard of his truck was just covered with paperwork, right? We're driving around, he's got the windows open, and all of a sudden something flew out the window. Piece of paper. And I go, oh my God, look at his paperwork. He says, I don't know, or whatever that was. Well, how about if that was a receipt for $1,000 worth of material that he had bought the other day, loaded in his truck, threw the thing on the dashboard, right? Okay. Now he lost the receipt, right? You gotta have a better system than the dashboard of your truck, right? So you always want to document repairs and renovations with pictures. You want to send the 1099s to your subcontractors. Anybody you pay more than $600 a year for services or like repairs, contracting, or services, you want to send a 1099 to. And you don't want to miss any of your administrative expenses, right? I have a whole list that I send people, my clients. Here's the administrative expenses that you should have. Like, you'd be amazed how many real estate agents forget to put their business miles on their expense report. Forget to put, if they're working from home, forget to put their home office in. Forget to add in their internet or their cell phone or whatever. So I have a whole list of those things that I send out to people. Hey, you're missing this stuff. As an investor, the same thing. As a real estate investor, if you're not tracking the miles that you ride back and forth to manage your properties, you're missing out, right? You're missing out on on good sized tax deductions. I just did a return the other day where this realtor investor had almost 40,000 miles, right? But I had to ask for them, right? For how many miles did you drive? Oh God, a lot, right? Went back, got a report, 40,000. Nowadays, you got mileage apps. There's all kinds of apps you can put on your phone for tracking miles. There's no reason not to track your miles, right? By the way, $40,000, 65 cents a mile, right? So that's a $26,000 deduction, right? Doing the math in my head, right? That they could have missed out on if I hadn't said, hey, where are your miles, right? So don't miss out on your administrative expenses. If you want that list, send me an email. I'll give you my email address afterwards, right? Retirement plans and health savings accounts, right? These are great ways. A lot of investors don't like retirement plans. They don't want to take money off the table to put, out of their real estate money pool to put into retirements. But I mean, if you're a broker, if you've got business income now, this is an old slide evidently because I'm using 2022. That number is now up higher, maybe 60 something. It's higher than 61. It's 66 or 67 maybe for 2024. Well, you can put away a lot of money in the right retirement plan, right? And like we talked about before, you can use your retirement plan contributions to get your income below the $150,000 so that if you're an active investor, you can take the rental losses, and that's a double dip. That's a double whammy. You really want to try to take advantage of that strategy. You also want to make sure you're doing your health savings account, right? You're making if you have high premium insurance, like a lot of us have, then you want to make sure you're making that health savings account deduction. That's a good one. It could be $7,000, $8,000 for a family, right? So all of this stuff adds up, right? Cost segregation is a huge hit against your income. But most taxes come in dribs and drabs, right? A little here, a little there, right? So if I had a rate done, as high as to lowest, cost segregation is always going to get you a lot of tax savings. Retirement contributions are always going to get a lot of tax savings, but you also got to pay attention. You got to be granular. You got to take, you have to pay attention to all the little stuff too, because if you save, if you don't miss some of your admin expenses and you save another couple $1,000s, and you don't, and make sure you make your health savings contribution, might be another couple $1,000s, and you time some of your expenses a little better. That's a couple more $1,000s. All of a sudden that adds up. Now you've saved $6,000, $7,000, $8,000, right? It's a great strategy. So you have to be granular with that stuff, and I always advise people to put money away in their retirement plans. A lot of people don't. I think it's a mistake. Traditional versus Roth, the difference for those of you who don't know, a traditional plan, you deduct as a tax deduction when you contribute it, but you're going to pay tax on it grows tax free, but you're going to pay tax on the money coming out as you take it out when you get older, right? A Roth contribution, you don't take a tax deduction. When you put it in, it grows tax free, and you don't pay tax on the money on the way out, assuming you don't take it out for at least 5 years, right? Now, I highly recommend Roth contributions for young people. I think it's a great way to build tax-free wealth at a time when you are young and you have a long period of time for it to grow, and maybe your income isn't as high, right? Whereas once people get a little older, their income tends to go up. That's when you really should be making the deductible contributions, because you're just getting that much more of a deduction, when you're in a high bracket. Okay. So when you're running businesses, there's a difference between using an LLC or an S corporation, right? So let's just use a brokerage business, right? Let's say I'm running a brokerage and it's an LLC, and my brokerage nets let's say $100,000 worth of income. Well, 15.3% self-employment tax I'm going to pay on all of that income. I'm going to pay $15,300 of self-employment, right? I don't want to pay that. Social Security and Medicare, right? I want to pay into Social Security maybe, but I don't want to really max it out. I'm going to get some Social Security when I'm getting older, but everybody gets Medicare. Everybody gets the same Medicare, right? You don't get better Medicare because you've paid in more, right? So there's no reason to overfund the government. So on $100,000 worth of income in an LLC, you're going to pay $15,300 of self-employment tax before you pay your federal income tax and before you pay your state income tax. So if you've ever heard if you take the 15.3 self-employment tax plus 15% minimum federal income tax plus 5% if you live in Connecticut, so minimum 5%, that's 40%, right? You ever heard the expression, I work 2 days for the government and 3 days for myself? That's where that expression comes from, right? So you want to try to keep that down as low as possible. And the way you do that is you use an S corporation, right? An S corporation allows you to take a reasonable salary on your income. I usually use 50% of your income up to about 100,000, and then we start to get a little more creative. But about 50%. So on 100K of income, you would take a $50,000 salary. You would pay in $7,650 of self-employment tax, but the other $50,000 you can take as a distribution. That $50,000 is not subject to self-employment tax. So now you've saved $7,650. That's on 100,000. The more you make, the more you save, right? So on 150,000, the difference is $10,000, right? On 200,000, it may be $12,000 to $15,000 difference, right? So you just have to kind of keep an eye on your income. And if you're running a business through an LLC and you see the income start to go up over net income over about 75,000, that's when it's time to start making an S election, right? And also, let's say you just you have a company, it's an LLC. Let's say you just did a flip, right? And you made $200,000 on a flip. Might be time to make that S election, because you can take an S election and make it retroactive 2.5 months, right? So I saw a flip on May 1st. I can go and make an S election on May 2nd, and that covers it because the election will be effective on February 15th or something along those lines, right? So kind of keep that in mind. All right. So that's sort of S corp versus LLC. You always want to use an S corp if you've got a business where you're making a lot of money, right? It makes a lot of sense to do that. Now, the last strategy we're going to talk about is using entity structure to reduce audit risk. Okay, and we're going to do that, and here's why. Right? Not only is using an LLC good asset protection, right? You want to separate your rental properties or your flips from your other personal assets, right? Reduces your liability. But a single member LLC, if you use it for a business, it gets reported on Schedule C of your personal income tax return. If you use it for a rental property, it gets reported on Schedule E of your personal income tax return. We don't want that, because what happens with that is you're giving the IRS all of the detail of your income and expenses, right? So they can see that you spend $30,000 on repairs and $40,000 on rent and $22,000 on meals and entertainment, right? Maybe a number you don't want them to see, right? On your personal return, a personal return is 6 times more likely to be audited than a partnership return, because partnership returns are pass-through entities. They don't pay taxes. Okay, the IRS typically doesn't really audit them a lot, right? Far less than individual returns. Why? Because the IRS uses cost-benefit analysis to choose who they audit. They want to make sure that there's enough meat on the bone for them to go after. If they're going to send an auditor to your office to go through your stuff for a couple of days, they want to make sure that there's a reasonably likely chance that they're coming out of there with some money, right? If they're auditing a partnership, the partnership doesn't pay any taxes, so there's very little for them to, there's no meat on the bone there, so they tend to avoid auditing partnerships, right? So by using partnerships so the typical partnership is like a husband and wife, or 2 family members, or 2 buddies, who get together and buy properties. You use a partnership, or I have people they'll have a partnership with themselves and a small corporation, right? Then you give the corporation 1%, right? And then you use that to become a partnership. Why? Because now I'm getting everything off the face of my personal return. There's a tool the IRS uses called a DIF analysis, and I don't remember what DIF stands for, but it's in my book. I don't remember what the exact terminology is, but basically they run your expenses against the national average for all. You put an industry code on your business returns, or on your like Schedule C and your Schedule E. Well, they run your expenses against other people's expenses on it as a national average. And the more your expenses are out of balance with the national average, the higher your DIF score is. The higher your DIF score is, the more likely you are to get audited. That's the high DIF score is what is commonly referred to as a red flag, right? So if you have expenses that have a high differential, then you've been red flagged, right? The more you're red flagged, higher chance of your audit. By putting those things on a partnership return, they never get looked at. So they're not subject to that scoring system like they are in your personal return. And what happens is the partnership gives you a K1 with the net number on it, and only the net number is reported on your return. So if I lost $20,000 on a rental property, I put it on Schedule E, the IRS can see all the detail. If I put it on Schedule E as a single member LLC, I put it on there as a partnership, the IRS sees one number, negative 20,000, right? They don't see any of the detail. They don't see whether I cross-segregated the property. They don't see if I took $40,000 in repairs. They don't see, whether they charge, $5,000 a month of entertainment to it, nothing, right? So it's a really good strategy for audit proofing your returns because you want to put as little documentary numbers on your personal return as you possibly can, all right? So we're getting near the end. I want to offer you guys a chance to ask some questions. I've got a couple of rules, no such thing as a stupid question. If I don't know the answer, I'll tell you I don't know the answer, right? You can stump me. While people are asking questions, take down this information. If you want to talk to me about your specific situation, my email is ted@landmarkcpagroup.com. My office number here in Shelton is 203-922-1742. As I mentioned earlier, everybody on the call is going to get a copy of my new book, Year-Round Tax Planning for Real Estate Investors. It'll be done by the middle of next month. Putting it together now, finishing up the editing, and then it goes to the book compiler to put together. So basically, it's done. So once that's basically printable, and we'll get everybody out a copy. You can also book an appointment to discuss your situation with me by going to my website at landmarkcpagroup.com. So if you have questions, throw them in the chat, or if you want to just unmute yourself and ask a question, feel free. Anybody got a question? Did I check the chat?
I do have a question. Can you hear me?
Yeah. Hey, Julie, how are you?
Oh, hi. Good. I'm sorry. I just jumped on. So I do have a question regarding these partnership LLCs. We just had our taxes done, and we said for my portion of it is 99%. My husband, who has a W-2, is 1%, as opposed to a 50-50 split, even though it's written as a 50-50. To the IRS, we did 99 to 1. Is that a problem?
No, if it's an LLC, you're allowed to allocate income any way you deem fit.
Okay. Yeah. Okay. Is that a good strategy? I mean, when we sell the assets, I can't go back and say, oh, no, it's less for me. So then it's more of a or less of a loss or less of a gain, if you will.
Are you filing jointly? If you're filing jointly, it doesn't really make any difference.
Okay. Yeah, we are jointly.
Yeah, because it ends up on your personal return no matter what.
Okay, but doing that 99 and 1 is all right.
Yeah.
Okay.
Yeah.
Perfect.
Because the net is exactly the same. Anybody else have anything? Greg Romer, would you recommend a cost segregation if you do qualify as real estate professional for a given year, but don't intend to qualify for the status in successive years? Yeah, I mean, I would definitely take it if I qualified in a given year, and I was able to do a cost segregation study that knocked down substantial amount of income, but I wasn't going to qualify in future years. I would definitely do that. Yeah, that would definitely be something I would do, even if I knew I wasn't going to qualify in future years. You only have to qualify for the year you're taking the deduction. Anybody else have any questions?
Ted, I have a question, if I could.
Sure, good, Nancy.
I jotted this down. I want to make sure I understand it correctly, but for a 1031, the property that you're buying has to be, I'm trying to understand, worth more? Like, I'm trying to understand if the property I sold is $1 million, is that the sale price, the assessed price, the appraised price?
It's based on the sales price. Yeah, I'm sorry.
Okay.
If I wasn't clear enough on that. It's based on the sales price, and then your purchase price of the new property has to be at least that amount or more.
Okay, thank you.
You're welcome. Anybody else got anything? Anybody working on anything cool these days? Anybody got a project they want to tell us about or something cool that's got going on? We got a few more minutes.
I do have a question. I'm back. If we are taking a using the LLC to pledge a loan, quote unquote loan, you can't see my fingers, but to close the deal. And we're pledging the LLC. I'm going to get a K1 personally for that pledge. Is that correct?
You have so ask the question again. I'm so sorry, Julie.
Okay, so we're buying an asset. I am on the management side of it. I'm a member, but not a managing member of the
Okay.
LLC. But we are short 160. We're going to pledge the, to get the rest of it covered by the LLC. We will owe a person 160,000 to give us a quote unquote loan to get us over the hump. And we're pledging the LLC, which in my mind, I'm going to personally be liable for that loan until it's completely paid for.
I think that's really deal specific, right? It's however you structure that with that person, because I've seen where the lender comes in and that the loan, if you put that loan on your balance sheet, for example, then it's a loan, right? If you're giving them equity in something, then they may have an equity piece, or they may have a split. Am I understanding that right?
Ah, that's interesting. Okay, so we're putting up the equity, the value of it as an LLC. Yeah, I'm just trying to figure out how they're structuring it, because I own 2%. It's nothing.
Yeah.
And I don't want to be held responsible for 10% of the liability. And that 10% now is given to me in a K1, whereby I have to write it off, or it's a gain on my side.
Could be. Yeah. We should, you know what, if you want to get more specific, if you want to get more specific with this, maybe, on a phone call or something one day.
Sure.
We could do
Okay.
that. Yeah.
Okay.
I think I would need to give you a better answer. I would need some more specific information.
Yeah. Okay.
So we have another, what are the tax consequences of a 1031? Well, the tax consequences of a 1031, if it's done right, is a complete deferral of the gain on the sale. That's the whole idea. You're gonna sell a property. Maybe you've got a big gain on it. Let's say you got a $300,000 gain. You do a 1031 exchange, you have no gain, right? The gain gets rolled over into the cost basis of the new property, right? So the depreciation schedule from the old property moves over to the new property, and then anything you pay in addition to the sales price of the. So let's say I sell a property for $1 million, right? That I paid $500,000 for, right? Now I go and I buy a property for say $1 million. All I'm doing is moving the depreciation schedule over. And I'm deferring the gain. If I pay $1.5 million for the property, I'm moving the depreciation schedule over for the first $1 million, but I get $500,000 of new depreciation because I've exceeded the sales price by that $500,000. Does that make sense? So I paid $500,000 more for the property I bought than for the property I sold. So I have additional cost basis to depreciate by whatever the spread is on the difference between the sales price and the new purchase price. But it results in a complete deferral in any case. All right, one more question. Anybody got one? Andrew asked, with a 1031 exchange, can you buy a portfolio or multiple properties as long as it's higher than your last sale? Yeah, you can. Now, there are some specific rules to that, right? Because there's some identification rules. You want to get with, if you're going to do something like that, you've got to get with the qualified intermediary that does that, because there's a way to do the paperwork to do that. But certainly a portfolio from one seller, right, works, right? Because it's basically one purchase, right? You just buy multiple properties. But if you buy multiple properties from different people, there's some rules that you have to follow. Okay. And yeah, you want it to be higher than your last sale. All right, guys, it's 9:04. It's past my bedtime. I gotta go. I hope you really enjoyed this. Thank you so much for coming on. And if anybody's interested, please get in touch with me. I'd be happy to talk to you about doing some planning and helping you save some money. All right. Have a good night. Thanks so much.